All right, everybody, welcome to the Dr. Stoxx Market Talks as we look at the trading view chart setup that I typically use. There are always a few changes that we make along the way to adjust to market conditions, but for the most part, what you're looking at here, and I'm going to take off some of the lines I have, what you're looking at here is my standard charting technical setup, and I use this setup to do analysis on the major indexes, the sector funds, and the Mag 7 and stocks that I'm interested in. Technical analysis only. We go to another site and several other sites, in fact, to determine whether the company is sound financially, whether they're growing or not, whether they have sound valuations and analyst support and all that kind of stuff. But this is where we start. We always start here with the technical chart. And we typically mark these up and mark, entry levels and support and resistance levels and that kind of thing. But let me just explain, because I did have an email request to this effect. Let me explain the technical parameters that I have on here. And I have several others that I'll be adding as we go that in my mind are kind of optional. But these are the standard ones here. So on top, up here with the price chart, we've got the candlestick charting, of course, which is a pretty standard technical way of looking at price. We've got the 21 period exponential moving average. William O'Neill is a big fan of the 21 EMA. I use it as well. He likes to say that when price is above the 21, good things can happen. When price gets below the 21, not so good things can happen. And that's not a firm rule. It's not a 100% accurate rule, but it is something that you want to pay attention to. We've got the black line here. That's a 50-period moving average. That's a simple moving average. And the green line, the thick green line down here, is the 200-period moving average. In my opinion, those are the best three indicators to have on moving averages, that is. And just by looking at the relationship of the three moving averages one to the other, you can see that we are definitely in a strong uptrend. 21 is above the 50. The 50 is above the 200. That's called a stacked set of MAs. There's good separation between the 21 and the 50. The 21 has been above the 50 for several weeks, even a couple of months. There's good separation between the 50 and the 200. 50's been above the 200 for months and months now. We're in a bull market, obviously. So those moving averages, they tend to act as both trend indicators and support when price is above and resistance when price is below. Now, the other overlay that I have on here is the linear regression channel. We'll zoom in a little bit here. That's the colored lines that you'll see behind price. The linear regression channel measures standard deviation away from a midline that runs through the highs and the lows of the current trend. If the LRC is flat right across the board, you're not in a trend, you're in a trading range. If the LRC is uptrending as it is here, you're in an uptrend. When it's downtrending, you're in a downtrend. So just looking at the LRC, we all obviously know that we are in an uptrend. Now I have the default 100 period look back on the LRC, and I would recommend using that one. You can go a little bit longer if you want. You can go shorter if you want. I wouldn't really go any shorter than 100, but you will sometimes see the LRC indicating an uptrend where your moving averages are not indicating an uptrend. And that can be kind of a conflict. And so that's also information that we can use for our trading. Now, I actually have two versions of the LRC on here. I've got one set at the 1.5 standard deviation. That gives me the darker color bands in the middle, salmon at the bottom, blue at the top. And then I've overlaid that with a 2.0 standard deviation. Gives me a nice little pink band down here at the bottom and a light blue powder band up here at top. And I have a little, I don't want to call it a mantra, but it's a statement that I make about the LRC, and that is that rule number one, buy in the pink in an uptrend. Rule number two, sell short in the blue in a downtrend. If you can remember those two rules, you can use the LRC, the linear regression channel, to make trading decisions. Now, Sometimes it gets down into the pink, like it did over here, and it just keeps on going. So you got to use stops, right? You've got to use protection to make sure that you're not getting in to not just a pullback, but something much more nefarious, something a lot more bearish. And the same is true of the upside. You might short the powder blue band up there at the top, and the LRC is in a downtrend, and it just is ready for breakout, and it just keeps going up. So again, not hard and fast rule, not 100% accurate, but if you use stops, you can make very good money buying the pink in an uptrend, selling the blue in a downtrend. Now, down here at the bottom of the chart, I've got volume bars, green for days that the close is above the open. So the stock or the index may in fact have lost money that day, may have fallen that day, printed a red number that day. But because it closed above the open, we get a green volume bar. And to me, that's accurate, right? If the bulls are pushing the price above the open all the way into the close, that deserves a green volume bar down at the bottom. And the same is true on the red bars. If the close is below the open, you get a red bar. And I like to eyeball the volume bars down here for volume balance, right? We're looking to see whether there's a predominance of green bars over red, red over green. We also want to see the intensity of that volume, right? Are the red bars taller than the green bars? Are the green bars taller than the red bars, etc.? You can get a pretty good picture of how healthy this market is by simply, not even looking at the price, just simply looking at the volume, right? And you're going to see kind of a mixed picture here. This is the S&P 500. This is the SPDR ETF that tracks that index. You can see we're getting a little bit toppy up here. We had a couple of big bars that started high and ended low. That's never good. Two bars like that on pretty good volume in both cases, that's distribution. People are getting out of this index thinking that it's not going to be going up any further. We've got a bunch of big earnings coming up with the stocks that are at the top of this weighted index. So there's probably a little bit of concern about whether companies will be able to hit their numbers going into, we're going into now quarter four. All right, so that is my the price chart itself. Now we go down to the bottom of the chart, you're going to see stochastics here. And this bottom indicator, it changes for me. Sometimes it's stochastic, sometimes it's MACD, sometimes it's the RSI, and I usually have a moving average overlaid the RSI. Those are the three that I use down here. These are momentum indicators. They typically give us a sense of whether price in the uptrend or downtrend is robust enough to keep going. And these indicators down here, which can flag bearish divergence in an uptrend, bullish divergence in a downtrend, can often give us some early signals. They can either get us out of a trade that's about to roll over, or they can get us into a trade that's about to take off. So those are the parameters that I use. Let me give you a couple of extra ones here that you might be interested in. There is a free parameter called divergence, and this is a indicator that measures bullish and bearish divergence per pivot points in price, both high and low. And if it detects divergence, that is to say maybe a higher price high but a lower indicator low, or sorry, higher price high, lower indicator high, or that's a bearish divergence, obviously, or a lower price low but a higher indicator high, that is bullish divergence. I did it again, but you know, you get what I mean. It will flag that for you. And here's something very interesting, right? This is the S&P 500. 6 of the momentum indicators are flagging bearish divergence right now at this little top that we're in here. So one of the reasons why we've gotten a little bit more on the bearish side, not completely bearish, but we've put on some protection, we banked some profits, took some profits off the table. This is the reason why, because we are expecting over the next few days a little bit of a pullback. It's such a good market. Still a lot of enthusiasm for bullish movements into next year. Don't think any sort of a pullback is going to last very long, but maybe 3 or 4 days. come back in here to test the 21 period moving average or the midline of the LRC. Both of those typically act as support. And we've got some protection on just in case that happens. All right, so that's that indicator. Let me take this one off and show you a second one. This one is not free. You have to pay for this one. It focuses purely on price, not looking at divergence, just looking at pivot areas of support and resistance. And then it will give you a buy signal, or in some cases on the top side, let me find a sell signal. There hasn't been one in a long time. Wow. Really hasn't been one in a long time. My goodness. All right. Well, you'll have to take my word for it. There are sell signals that show up as well, but these little green triangles are the indicators telling you that it is now safe to buy this bounce. You can also see in the latest indicator where you should take your profits and where you should set your stop loss. And those aren't dynamic, so those will stay at those levels. And it's a nice indicator. This is called, if you're interested, this is called Supply Demand Pro. Let's take that off, and I'll show you one more, and that is the market bias indicator. And really, I don't know how this is calculated, but this is also a free indicator on TradingView. And you're going to get 4 different colors showing you the direction and the intensity of the trend of the market. Strong green, obviously. Dark green is the best kind of bullish market. Light green is maybe getting a little iffy. And then, I don't know if we have, there we go. There's some red. So red is for down trending markets. Dark red for strong, light red for weak. And the idea is that you kind of trade from the transition, right, between the red and the green. And it doesn't always work, but this one did quite nicely. That's the market bias indicator. And you know, you could make a very good living if you had very good trade management by simply buying bullish positions with dark green and oversold in your momentum indicators. Dark green market bias, oversold, in this case, stochastics. You just simply buy there. You have to use your stop loss. You have to have a target price. Your trade is worthless without those things. But with that in place, you could make a pretty good living, I think, trading market bias in stochastics or market bias in RSI or even market bias in MACD, buy and sell signals. All right, guys, I'm going to wrap it up there. I'm going to produce this video, send it over to the YouTube channel, and I'll be right back on board with our next segment. Bye for now.